Good morning, everybody. This is the live market open for August 3rd. It's Wednesday. My name is Yohay, Elam, Forex Crunch and Market Movers, and doing the show as usual for FX Read. Hope everybody's doing well. As usual, today in the show, we'll cover recent developments in markets. Of course, talk about the charts and levels. And of course, we have a few big events in the first week of the month. We have the Bank of England's big decision. We'll do a preview for that. And as usual, first Friday of the month, we have the Bank of England's decision. Sorry, I said that twice. The non-farm payrolls, and I'll do another U.S. elections update, and that's because we had, I think, significant developments in the past week. Okay, and of course, we'll do a preview for next week. If you cannot see the chat box alongside the screen, please go to the address here, tlk.io/fxread-forex-live-video. Good morning, Luca. Good morning, everybody else. Your questions, as always, are welcome. Okay, so what's going on in general in the market? The US dollar is on the back foot. Okay, that's the main headline. The Fed does not rock the boat. The Federal Reserve did acknowledge some improvement in the US economy. Later proved not exactly correct, but they were a bit more upbeat, but gave us absolutely no hint about an upcoming rate hike. We did have one hawkish dissenter, Esther George, and they talked about stable inflation, rebound in jobs. They didn't tell us anything we didn't know. Okay, at the beginning the dollar went up a bit, but then it fell. No rate hike anytime soon. The next big event that we had last week, the next big rate decision, came from Japan, and here the Bank of Japan also did quite well, only a bit. They also didn't do much. They disappointed, but this did have an impact, of course, on the yen. The yen strengthened a lot. So the Bank of Japan, let's look at the dollar-yen chart. Kuroda and his colleagues announced an enhancement of the ETF buying program and extended the dollar program. Anyway, very small steps. I think we talked about this potential disappointment. Of course, no helicopter money, not before the US elections. So we had dollar-yen falling quite a bit, okay? Stronger yen, as there is not enough money to go pushing the yen lower, okay? So dollar-yen is falling. It was around 102, 103. And the lower expectations already pushed it down. And then, extended its falls also this week. All in all, quite a big move for dollar-yen, big strengthening of the Japanese yen across the board, in fact. Okay, that's another big event that happened last week. What we did have this week is that the Japanese government introduced a stimulus program worth 28 trillion yen. That's around 270, 280 billion dollars, but this was well telegraphed. This was expected by everybody. So when it was announced that we sort of had buy the rumor, sell the fact again, that caused the second fall of dollar-yen, the second move higher in the yen. All in all, a huge move. Remember, the expectations for action from the Bank of Japan and the government after the elections 1 month ago, actually, they sent dollar-yen as high as 107.50, and look at this big return. We're basically around the post-Brexit levels in dollar-yen. Remember, it's also the lack of action from the U.S. Federal Reserve, but the yen's move is bigger. Okay, so that's the big event here. Also in markets, we had oil prices falling below $40. That's significant, of course. More supply across the board. No fresh problems in Nigeria, Libya, or Canada, and good stuff. And the U.S. production continues ticking higher. It sort of went up. So we have WTI crude oil. Look at this big move across the past few weeks, and the biggest deterioration came recently, with WTI crude oil falling under $40, a very round number. And this has some impact on the Canadian dollar, but not only on that. Question here from Luca, and good morning, Hans. So Luca asks, I'm wondering if the Bank of Japan is using up so much of its balance sheet for the massive QE program. How much is left there for FX intervention? We know that the Swiss National Bank had to throw in the towel, and it wasn't even doing QE. Sharks smelling blood in dollar yen, as the emperor appears to be naked and shieldless. Yeah, I agree. Well, in terms of intervention, Japan has many problems. First of all, it's a very liquid market, and the market forces that felt the blood, smelled the blood, did act against it, so it has no chance. In addition, the Bank of Japan and Japanese authorities in general are closely watched by China and, more importantly, by the United States about these kind of interventions. So I think it prevents them from doing really big things, market forces and politics. And now, what do they have left? Not that much in terms of QE. They're already gobbling up Japanese bonds at a huge rate. So they're now also buying ETFs, and basically the next big thing would be what's called helicopter money, basically, or handing money directly to the hands of consumers, or that the Japanese government will not even issue bonds to markets, but sell them directly to the Bank of Japan, and they will not carry a maturity date. Basically, a less hidden way of doing of monetizing the debt. Okay, but they don't do that for now. One of the reasons is the upcoming US elections, but anyway, they can always do more. The Japanese government did announce more stimulus. If they want even more stimulus, they'll have to go for helicopter money. Yeah, okay. Good morning, Ramon, as well. Good morning, everybody. That answers the question. Yeah, and markets are always becoming hungry. Okay, continuing to the Australian rate decision. The RBA did cut rates. They cut them from 175 to 150. Let's look at the chart in this case. So we did have a move lower yesterday, but it was very, very short-lived. Basically, this rate cut was telegraphed, okay, as well, and we all knew it was coming. And the weakness of the US dollar meant that we only had a small dip in the Australian dollar, and then we had it rise once again. So let's talk a bit about levels. So currently it's 75.86, well, falling a bit this morning. 76 is some weak support. 76.40 is stronger. Well, sorry, resistance, not support. And no, sorry, that would be 76.60. On the downside, if we have a continued fall to the round number of 75, provides support, and then 74.40. Okay, so that was a big event yesterday, but well, it wasn't unexpected. In addition, the RBA signaled that that's it, basically. Okay, that after this move, they will probably not add more rate cuts, or at least they'll be in a wait and see mode. So they did react to prospects of lower inflation, a very slow transition from mining to other sectors, some cool down in property markets, but not. At least for now, it seems like a one-off. Okay, and there's something we'll talk about later on. US polls post-convention, post-DNC convention. They show a big shift towards Clinton, and again, currently I don't see a big move in markets, but we might see it in going forward, and we'll focus on that later on in the show, on politics and their impact on markets. Okay, comment here from Luca. If I were Kuroda, I'd offer a free Ferrari to anyone willing to buy and hold for a year, $5 million yen. Yeah, that could push dollar yen higher, push the yen lower. I don't know if they'll go for it, but anyway. And now let's talk a bit about Brexit before the Bank of England's preview. Just some figures we had in the past week. More signs of worries in the UK, various business surveys and things like that. But the most important ones, manufacturing PMI, it looks bad. Okay, it's the final figure for the month of July. Remember, we had a special release of PMIs. They both looked bad. The final figure looked even worse. It's a small sector, but still important. So that was negative. On the other hand, the construction PMI wasn't as bad as expected. Still shows contraction, 46 points, but not that terrible. Other data will show worries. We had just tonight the independent think tank NISR, forgot what the initials stand for, but anyway, they forecast a recession. So basically, clouds are relatively dark, and that feeds into the Oh, I didn't talk about what we actually. No, sorry. Okay, other figures in the United States. Well, last week we had the durables goods orders. They came out on the same day of the NFP on Wednesday when we had the show. They missed expectations, very disappointing. That means that investment in the United States doesn't look good. It was then followed up. Well, durable goods orders feed into GDP. Huge miss in the United States. That also pushed the dollar lower, even more than the Fed, I would say. So we had a miss with only 1.2% instead of 2.6% expected. Let's move a bit to the chart. So let's start from the top. Euro dollar. We have seen euro dollar moving higher, moved above this resistance line at 111.90. Currently 112.06. Already reached a high. Got close to that resistance line of 112.50. That's followed by 113.35. So we did move to the highest level post-Brexit. We're currently at, highest levels in a month. Euro dollar has been one of the more frustrating currency pairs in general. I wrote an article lamenting about this lack of movement. Anyway, now we're currently slipping down, 111.90 support, followed by weak support 111.30 and more stronger support 110.50. So it basically reflects the weakness of the US dollar more than anything else. Finally, a breakout of sorts in euro dollar. Okay, pound dollar. If you look at the bigger scheme of things, we're currently at the top of the range of recent weeks. We had some slowdown in movements in pound dollar after those crazy days. So yesterday's better than expected construction PMI contributed, but also here it's basically expectations haven't changed too much after those weak PMIs, but it's mostly the weakness of the US dollar. Again, this morning we're seeing some renewed dollar strength, some recovery, but in general, levels to watch here, 132.50 and support at, I would say 130.65, resistance at 134.80, a line that proves itself more than once. I believe we'll have another 24 hours or so of relative stability before the Bank of England makes its move, and we'll have a special preview for that. We already talked about dollar yen, reflecting not only US dollar weakness, but Japanese yen strength. Dollar CAD, so here it's a mix. This pair is torn between the weakness of the US dollar and the weakness in oil prices. So currently we're just under resistance at 131.40, just under this line. Further resistance at 132.40, support 130.80, weak support, and 130 is very strong support for the Canadian, for dollar CAD, okay? So it's really mixed between these lines. I already talked about oil, but let's look again. Basically, very straightforward deterioration in the price of black gold, mostly because of inventory data in the United States showing more and more supply. Remember, this is a pendulum swing. When prices rise, the US produces more oil. It takes time to adjust. When prices fall, I believe we'll see an eventual fall in production. But basically, prices cannot rise or fall too much. At least in dollar terms, in percentage terms. Of course, we're once again, I think, in a bear market, if you wish. Let's continue. We talked about the Australian dollar here. So we did see it fall, but with the weakness of the US dollar and the prospect of no more rate cuts from Australia, we're seeing some higher ground. Kiwi dollar, lots of movement here. Many don't look at this currency pair. So we had a mixed bag here. We had, on one hand, milk prices jumped a lot. 6.6%. This is positive. On the other hand, wages in New Zealand missed expectations. Next week, we have a rate decision in New Zealand. They'll probably cut rates. Anyway, currently 71.90. Let's add another line here. So currently, well, 72.60 was resistance. High resistance at 73.30. Currently sliding. 71.50 is, well, let's modify just a bit. 71.60 as support, followed by 70.50 and 69.50. Big movements in the New Zealand dollar in terms of percentages, less in terms of pips. Dollar Swiss franc. Well, here we had quite a big fall, and this certainly reflects the fall of the US dollar more than anything else, but perhaps the Swiss National Bank is intervening quietly. So currently 96.64, 96.40 is some kind of support, resistance just there at 97. Anyway, I don't want to talk too much about the franc. Well, further support 95.50 and 98 is high resistance. Euro Swiss, very stable in the range, 108.30. It already saw higher ground at the 109 level, back to lower ground. I think that here it'll find some support by the Swiss National Bank. Euro pound, well, we had the big Brexit move and an extension, currently cooling down just a bit, currently 84.25 resistance. Well, 85, the round number, is a line to watch. And on the downside, we have 83.50. The bigger driver is the pound with tomorrow's Bank of England's decision. We'll preview later on. Euro yen, 113.35, reflecting mostly the strength of the yen. Strength of the euro against the dollar is certainly trailing behind. Support at 111, resistance 114.50, and 116. No, let's make it 117. Lots of choppiness in this currency pair. Okay, I see a question. I'll just complete the roundup of charts. Currently, pound yen, the Gepi, extremely wild moves in the past month, now a bit slowing down. Currently 134.50. We saw the pair finding resistance there just under 140, with 143.40 as high resistance support at 128.50. Okay, so we talked about all the currency pairs we usually do in our roundup. We have a few more data pieces. I see a question first. Cable, Lucas says, cable post-Brexit view, a most classic bearish pennant with 125 target. And Lucas shares a chart with us. Let's share it with everybody here. So here we go. Wow, that's quite a nice move here. Yeah, things are narrowing in on pound dollar. So you think it'll fall to 125. That's quite a big fall. Everything depends on the Bank of England. I believe we'll see even more narrow trading until tomorrow, despite a big figure released later today. So yeah, quite interesting. I think 125 is a bit too far. The low has been 127.90. But it requires that the Bank of England will do a lot. And the Bank of England tends to do, well, not too much. Let's see. The unreliable boyfriend, exactly. That's what Mark Carney is nicknamed. That's how he is nicknamed. Anyway, but I believe tomorrow they will do at least something. We'll do a preview for that. Anyway, thanks for sharing the chart. And yeah, let's talk about other data figures and then talk about some events for today. So we talked about durable goods orders and GDP. Both were terrible. And the GDP, I'll just say it's not everything was bad there. So let's start with the bad news. Bad news, 1.2% annualized growth, something like 0.3 quarter-over-quarter. Third consecutive quarter of poor growth. Okay, Q1 was revised to the downside to only 0.8. Very slow start to the year. On the other hand, some components of this poor growth were from the bad components. So that's government spending, which fell, and that's perceived as bad growth, and inventories. Inventory slashed from the figure, something like 1%. So If it were not for the big fall in inventories, it would have been something like 2.2, more or less within expectations. Now, when inventories are depleted, we expect them to be replenished in the next quarter. It doesn't always work this way, and it isn't always a one-to-one pendulum swing, but anyway, it's not as bad as the headline shows. In addition, personal consumption, which is considered good growth, this rose 4.2%. Okay, so that was GDP. Elaborate on that just a bit more. Eurozone growth, we had some figures coming out of Spain and France, but we didn't have the German figure. So according to the data we have at the moment, Eurozone GDP came out at 0.3 as expected, did not do much to move the euro. And inflation, headline inflation beat expectations with 0.2, but core inflation remained 0.9. Anyway, it came after the ECB decision, so it did not have the same effect. Chinese PMIs. Surprisingly, the government figure was worse than the unofficial figure. So the unofficial Caixin figure topped 50 points, just a bit over that, but shows some improvement in the Chinese manufacturing sector. On the other hand, in the United States, manufacturing PMI came out a bit under expectations from ISM, 52.6, and the employment component does not bode well for the NFP. But today we have bigger hints for the NFP, and the manufacturing sector is small. And we talked about milk. Today's events. Today we have key events, top tier ones, which are all hints for next event. Let's start with the UK final services PMI. Remember, we had a special post-Brexit report from the UK, and that came out, as you know, worse than expected, 47, and now we'll have the final figure. So we're expecting a confirmation of this figure at 47.4. But who knows? The manufacturing figure came out worse than the initial one, while construction, which was not revised when we had only the final figure, came out better than expected. Anyway, this is a key event. This could perhaps shape the last thing for the Bank of England. Maybe not. Maybe they've already made up their minds. They have enough data, have their own quarterly inflation report. But anyway, I'm sure it'll move markets, and that's at 8:30 GMT after the show. Afterwards, we have at 12:15 GMT the ADP non-farm payrolls, the private sector report for the United States of America. And here we're expecting a gain of 170,000 jobs, more or less like the previous month that showed 172. It's a big hint for the NFP. It doesn't always reflect what we're going to see there in the NFP, especially in the report for May. We had an okay ADP, and well, the non-farm payrolls was horrible. Big gap of let's look at this. Was something like well, ADP was 156 for May, and the NFP was only 11,000 according to the revised figure. But anyway, it still moves markets. And then, even more importantly, we have the ISM non-manufacturing PMI, the services sector. Once again, it's a day of services sector indices. Here, the expectation is for 56 against 56.5 last time. Watch out also for the employment component. This is considered a big hint for the NFP. Okay, we also have crude oil inventories at 2:30. Let's see if production continues rising. And the Australian retail sales at night for those of you trading the Australian dollar. Okay. Further events this week. What we'll do in the preview soon. Tomorrow is Super Thursday. Just looking at the timings, we have all the releases, quarterly inflation report, and the statement and the decision at 11, and then press conference by Mark Carney at 11:30. Also tomorrow, US jobless claims, the weekly figure, and US factory orders. I would say both are sort of second-tier figures. On Friday, we have another report from the RBA. Well, could move markets could move the Aussie. Maybe yes, maybe no. It'll give us hints about the next moves. German factory orders, a bit volatile, but still of importance. And of course, double feature jobs report with the US NFP at 12:30. We'll do a preview for that. And the Canadian jobs report at the same time. don't trade to dollar CAD at this time. Okay, so now we ran through all the information, the next events and previous events and what's going on in markets. Now let's move on to our special previews, okay? So this is a preview for the Bank of England's decision. It's dubbed Super Thursday. Why is it called Super Thursday? It's because we have 3 events. We have the inflation report, which comes out only once every 3 months, only once per quarter. We have the decision itself, and this time they're expected to do something. And we have the meeting minutes from that decision. We also have a press conference by Mark Carney around the inflation report. So all these are planned events. What makes this Super Thursday even more super is that in the previous rate decision, the Bank of England told us that they are going to loosen monetary policy. They just need more information. Of course, the big trigger is Brexit. And June 23rd, the United Kingdom decided to leave the European Union. We had huge moves in markets. The pound fell, as you know, quite a bit. It's still 10% off the pre-Brexit levels. Bond yields fell quite a lot in the United Kingdom, despite, well, uncertainty. Stock markets plunged but recovered quite quickly. And we don't have a lot of hard information. We don't have too much retail sales, GDP, manufacturing data. We mostly have business confidence, consumer confidence figures. Nevertheless, in the last meeting on July 14th, the Bank of England told us it's too early to make a decision. They didn't have enough information. They wanted to get their own quarterly inflation report. And in the same week, let me remind you, we finally had it came out quite quickly. We had a new government. So basically, Theresa May came into Downing Street one day before Mark Carney, before the Bank of England's rate decision. So I believe it also has to do with that. I believe there will be a significant coordination. But now they have more data. They had time to talk with the government. They had time to assess everything. So they did tell us that there's going to be loosening. Now, it wasn't that sure because another point here, Martin Wheel, a prominent member of the MPC, said a few weeks ago, he's not sure there's really a need for more easing. The Bank of England cannot do much. And that's true. Interest rates are already at 0.5%. QE is big enough and bond yields are very low. What else can the Bank of England do? We need more political certainty. We need perhaps more fiscal spending. But then came the PMIs, the special PMI report, and he said, okay. This changed my mind. It's a game changer. We need to do something. I believe that Wheel, which was a more hawkish member, if he turned dovish, that makes it certain that we'll have something. Okay, so now let's look at the options. Options are for a 25 basis point rate cut for from 50 basis points to 25 basis points. That's more or less priced in by markets. And another option is more QE. Some talk about an additional 50 billion pounds. Some talk about 75 billion. The program currently stands at 375 billion. Last changed in July 2012. The last time the rates were changed, that was back in March 2009, so it's over 7 years, okay? I believe that one move is priced in. So if we'll have QE instead of a rate cut, markets are expecting a rate cut, that is more or less expected. The pound will shoot up and down, but basically remain in the same place. Volatility, but without being a game changer. If we'll have two moves, if we'll have both the rate cut and more QE, that'll deal a big blow to the pound, and that'll mean that the pound could fall. Some expect it to fall towards 130 and even below. I'm not sure we'll have a fall under 130, especially from current levels around 133. But let's see. What else can the Bank of England do? The Bank of England can do more with its funding to lending scheme, FLS, more targeted loans. What's it's called in the in the Eurozone. It means conditional lendings to banks on the condition that they will lend to the real economy. they can buy corporate bonds, they can do other stuff. Basically, the Bank of England, which planned on raising rates actually before Brexit, at least last year, they have less tools to loosen policy. They have lots of tools to tighten policy. And in addition, it all depends on the government. So we have last input comes from services PMI today, the final figure. More input that we're not aware of, at least I'm not aware of, is the coordination with the government. So we might have a small move by the Bank of England, but a bigger move from the government. The previous Chancellor of the Exchequer, George Osborne, talked about, before the Brexit, to have another austerity budget. He was champion of austerity, and Philip Hammond said, no, the new Chancellor, it's not on the cards, so there might be big fiscal stimulus. If the government does a lot, the Bank of England does less. I believe we'll have one move, perhaps only more QE instead of instead of rate cut. And I think that's more or less priced in. If the Bank of England will surprise with no moves, the unreliable boyfriend, Mark Carney, then perhaps we'll have, shoot high move up in the pound to 134.80 or above. And if we'll have two moves, I think we'll go towards 130, but not below. Okay. Question here. Why didn't they appoint Carney as England coach and Mourinho as head of the BOE? Would have been more credible. Yeah, could be more interesting. Maybe they should switch some jobs around to see. Maybe one guy is fit for the other job. Anyway, the Premier League begins soon, right? So it could be interesting. I'll be watching the rivalry between Pep Guardiola and Jose Mourinho. We're stars here in Barcelona and Madrid. Anyway, that's the Bank of England's preview. Remember, in general, one move priced in. A lot depends on also what they say in the statement, in the meeting minutes, in the quarterly inflation report. Do they expect a recession or not? Are they planning to do more moves in the future, or more of a wait and see mode, or will they promise something? Probably not. So it not only depends on the moves, but remember, one move is priced in. That's the main message. I think I've said it enough times. Okay. That was the preview for the Bank of England. I think it's the main event of the week. And now, this is the preview for the non-farm payrolls released on August 5th for the month of July, July 2016. In theory, the Federal Reserve is data dependent and it has two mandates, employment and inflation. Inflation used to be a worry, and then now it's not that much of a worry, but jobs became a worry of late, especially with the terrible report in April and in May. May saw, according to the revised data, only 11,000 jobs gained. But on the other hand, we had in June, we had 287,000 jobs gained. So a big compensation, but what exactly is going on? We got used to very stable reports, around 200, even a bit higher, but relatively within expectations or not huge surprises. Now we had 2 months, even 3 months of big surprises. Okay, so markets are expecting a return to stability. 180,000, just under the 200 magic number. Okay, wages are expected to rise 0.2% month over month. Last time, the month-over-month figure was disappointing with only 0.1, but the year-over-year was okay with 2.6. I believe with 0.2, wages used to be more important until the last 3 months. I think now the headline figure returns to its headline role as being more important. If we'll have, I believe, above 200,000 for a second month in a row, it'll be good for the dollar, it will help it recover. We don't need much above 200,000. We don't need a big beat. We just need more stability, more certainty after those terrible months of April and May. If we'll have another disappointment, another move, under expectations, and especially under 100,000, it'll be devastating for the dollar, joining on the heels of bad GDP, bad durable goods orders, general feeling of a slowdown. Okay? Remember, if we might have a good headline report, but poor wages, or the other way around, and we could have big revisions as well. So as always with non-farm payrolls, trade with care and watch out for sometimes the first reaction is not the correct one. The dollar could rise initially but then crash, or fall down and then rebound quite strongly. So it's not only the headline number, but this time it's the most important thing, okay? After a few months that wages were more important, okay? Unemployment rates, this is more important politically because we know that the unemployment rate depends on the participation rate. So those trading markets will probably ignore it. I mean, if they see the unemployment rate rising, but the participation rate rising, it's actually good news because more people are into working, are jumping into the job market. And if we'll have a fall in the unemployment rate to even lower levels, but the participation rate falls, it'll be ignored by markets, okay? It means that it's actually bad news, okay? But for politics, it does matter, the headline figure, because, well, Clinton is running on the Obama ticket, and, well, she's sort of the incumbent, and better data, but lower unemployment rate is better for her. Higher unemployment rate is good for her opponent, Donald Trump. In any way, the US dollar enters this event on the back foot, on the heels of weak figures in the United States. So we'll need a good report to stabilize it, to help it recover. And if we'll have another weak report, it'll hit the dollar hard. So the risk is asymmetric, more risk to the downside with the current bias. All right. But remember also today's figures, non-farm payrolls, ADP non-farm payrolls and the ISM non-manufacturing PMI will have an impact on shaping expectations. Question here, whatever the NFP, the Fed has proved it will find any excuse available to sit in the elections out. Only an inflation surprise could wake them up, in my view. I agree. I think that the Fed will not act before the elections. Whatever happens, they don't want to be seen as intervening in the political process. If they raise rates, it could dampen the mood, hit stock markets, and help Trump in theory. And if they, well, do much for the economy, it'll help Clinton. They will probably just sit on their hands, as you said, and if the economy improves, revised GDP growth, good job gains, and global implications, Brexit will not be as bad as currently perceived. I think there is a chance for rate hike in December, but again, after the elections, okay? Let's look at rate hike expectations and then move to the next preview. So according to bond markets, according to this FedWatch tool by the CME Group, the chance for rate hike in September is 12% at the moment. It has been falling. November, more of the same. In December, already around 40%, okay? So 61.5 against the rate hike. According to bond markets, the rate hike is expected basically in June 2017, okay? Remember, these things move all the time, but anyway, for the next meeting, we'll have to have really extraordinary, well, amazing NFP now, amazing NFP in early September, upward revision and growth, basically impossible, okay? So that's the NFP preview. And now another update, second week in a row, I know, but about the US elections, okay? Because we did have a big move. We did have a big trouble for Trump with the Khan debacle. If you haven't heard the news, I know I'm a bit of a news junkie, and most people aren't, even though trading markets are focused on what things that move markets and not only politics. So we had the Democratic Convention last week. It began with economist fights with Bernie supporters, lots of scandals. It began quite badly, but things improved quite quickly. They had a well-organized event, good speeches from Michelle Obama, Barack Obama, Bill Clinton, generals, Joe Biden, you name it. And Hillary Clinton's acceptance speech was okay as well. Lots of balloons. Anyway, it seemed more successful than the Republican Party. But most importantly, there was one big event there. If you haven't seen this, the parents of a fallen soldier, they're originally from Pakistan, if I'm not mistaken. They came to the United States. Their son served in the US Army in the invasion to Iraq and was killed there. Okay. And they came up to speak in the Democratic Convention, and the father, told Trump, you didn't even read the Constitution, was basically turning against Trump for Trump's desire to ban Muslims entering the country, okay? So that was a very powerful speech. It was noted by everybody that it was powerful. It could have stopped there, but Trump decided to retaliate. In an interview over the weekend, he said that the mother of the fallen soldier, he hinted she wasn't allowed to speak, which was totally wrong. She was too hard for her, and she gave interviews elsewhere. And he said also, when he was asked about sacrifices, he talked about his own successes. He only dug a deeper hole. What he usually does, doubles down on previous comments, doesn't apologize, doesn't keep his mouth shut. I mean, when Bush or Obama or other politicians are faced with words from parents of fallen soldiers, they show respect and then move to talk about the issues. They don't confront bereaved parents. So, well, I'm talking a lot about this because this had a big impact on polls. So let me show you. I'm talking just to give you a lot of background. I'm sure some of you already are aware of this. Anyway, this is the 538, Nate Silver, the math guru. This had a big impact. According to his models, if the elections were held right now, this is a volatile model, Clinton has a chance to win by 86%. Look at the big shift. Trump was leading after the convention we talked about last week, and here's a huge leap for Clinton. Also, in the more moderate polls, she has a clear lead, 68%, a big post-convention bounce for Clinton. Mostly, I would say, on this debacle. We also had President Obama and perhaps more importantly, quite a few Republican candidates moving away from these statements. And even Trump himself began complaining about a rigged system, began sort of preparing himself for a loss in the elections, acknowledging that things are going against him. Okay, now let's return to markets and why is this important? In general, markets prefer Republican presidents. They prefer lower taxes and lower regulation, and not the Democrats, which are less business friendly. But this time is very different because Trump is very unique. He says a lot of things. He's unstable, has a very low attention span. And regarding trade, he promises better deals and to break up current deals. And this is not market friendly at all. With Clinton, we have continuation. She's not exciting, of course, but she's a well-known mainstream candidate. She was influenced by Bernie Sanders and now also talks against the TPP. But she is also, as Sanders said and others said, influenced by Wall Street. And markets do believe that if she enters the White House, she'll be a continuation of Obama in terms of his support for trade deals. Okay, so basically, it's Clinton continuation against a mainstream candidate against Donald disruption. So with higher chances of Clinton winning, this is positive for markets. I would say we'll have lots of ups and downs. It's 3 months until the elections in the United States, a very long process over there. And there is an outside chance that Trump will be replaced by his own party that will have either Paul Ryan or Mitt Romney or who knows, or he will, instead of Trump, is the Republican candidate. In that case, of course, markets will slightly prefer a Republican president. But anyway, Clinton is not exactly a left-winger. So anyway, it'll be less of a risk event for markets. Okay, there's a chance that Trump will quit when he was asked in an interview a few months ago or a month ago about if he'll be elected, will he serve? He didn't give a straight answer, so you never know. He's a bit crazy. Anyway, this is a picture again from happier days. Both couples, Donald Trump when he married Melania Trump, among the guests came Bill and Hillary Clinton. Okay, that's back in 2005. The relationship isn't as warm at the moment. Okay, so that's an update. I didn't want to repeat the same theme again, but I think it's an important development. Okay, comments here. The guy is Zoom material, not White House material. I agree. It was quite entertaining for a while, but now it has become serious. Okay. Luckily, he's his own best enemy too. Just let him voice his deliriums and people will run away, right? So I think that when he sticks to script, when he reads out prepared speeches written by him or by help from his advisors, he makes a case and he does carry away some people, but usually it's just being Trump, not using the teleprompter or teletrompter, and usually he is crazy. Okay, so let's see how things develop. According to all those math gurus, Nate Silver and others, we have to wait about 3 weeks after the conventions to get a better picture. So somewhere in around, I would say 2 weeks from now, if we'll have a clear leader, in this case Clinton, it, according to history, can show that she'll win the elections. But this election cycle has been crazy, so you never know. Okay. Anyway, that's it for the update on US elections. And now let's do a preview for next week's events. This is a preview for the events of the week of August 8th to August 12th. Sorry. So this is a relatively slower week after 2 very exciting weeks with the Fed, Bank of Japan, Bank of England, non-farm payrolls, ECB. Now we'll have a bit of a slowdown. Okay, so on Monday we have Chinese trade balance. Remember, it's important to watch out for levels of exports and imports to see if they're both going up or both going down. Up means more global activity, down means less. So it doesn't have an impact only on the Australian dollar, but also on other currencies. Tuesday, we have the US labor costs, sort of complementary figure. Usually not that important, but it stands out with the thin calendar. Labor cost, this reflects both wages and inflation and employment. On Wednesday, we have the oil inventories as usual, and the RBNZ decision. There are high chances of a rate cut also from New Zealand, hot off the heels of the Australian rate cut. Okay, so for those of you trading the Kiwi, this is an important event. Of course, watch out also for the statement, not only for the actual decision. On Thursday, we have just Chinese industrial output, another key figure from China. See how their factories are doing. US jobless claims as usual. And on Friday, that's a very big day with top-tier figures. So we didn't have the German GDP, but this time, we don't have it this week. We'll have it next week. Sorry, we didn't have it last week. We'll have it this week. In the upcoming week, we'll have, and Germany is, of course, the largest economy, largest country in the Eurozone, and that's Friday morning. And in the afternoon, we have double feature for the US consumer. We have retail sales for July. Most of the US economy is consumption. Sort of a first look also at Q3, the month of July. And we have consumer confidence for August. So this is a forward-looking figure from the University of Michigan. Okay, so 2 important releases. Friday is a really big day, especially for euro dollar. All right, so that's the preview for next week. Yeah. Okay, and now before we wrap up, let's take a quick look at the chart. See if we have any big movements. No, not that much. Well, the slightly weaker Slightly stronger US dollar. Not going anywhere fast. Okay. So this is the wrap up for the live market open for Wednesday, August 3rd. All in all, the US dollar is on the back foot due to the Fed and due to weak GDP, durable goods orders. The Bank of Japan also disappoints markets, but in a different way. The yen strengthens. Japanese government doesn't help the yen. Well, doesn't help weakening the yen because it announced exactly the stimulus program that was expected. Oil prices are falling below $40. A bit of a side story at the moment, but production continues rising, and this could also have implications. We did have action, not from the Fed, not from the BOJ, but from Australia. We did have a rate cut, and in political news, we have a big shift towards Hillary Clinton in the US presidential elections. More worries about Brexit. Tomorrow we have the Bank of England's decision, the biggest event on the calendar this week. They're expected to do something, probably one move, either cutting the rates or more QE. Doing two things will have a negative impact on the pound. Doing nothing will have a positive impact. Remember that they can announce something together with the government, and that's a wild card that we don't know about at the moment. Other data, we talked about big miss in US GDP weighing on the US dollar. And the first hint for the NFP was worse than expected, the ISM manufacturing PMI. Today we'll have the final UK services PMI just after the show. This could be the last input for the Bank of England. Remember, the services sector also in the UK is the biggest sector. And the initial release was very poor, 47.4. Expectations are for confirmation of this figure. And then we have two big hints for the non-farm payrolls at 12:15, the ADP non-farm payrolls, and then the ISM non-manufacturing PMI, the services sector report for the United States. Tomorrow, of course, Super Thursday, we talked about that a lot. So 11, we have the decision itself, and then the press conference by so-called unreliable boyfriend Mark Carney. On Friday, of course, big event is the US non-farm payrolls, expected to show a return to stability with 180,000 jobs gained. Headline figure matters more than wages. Let's take a look at the charts in this wrap-up. So starting from the top, euro dollar did break above 111.90, the post-Brexit high, made a false break on Friday and then a bigger move today. Currently getting comfortable in the range, 112.50 resistance, 111.90 support. Pound dollar did move higher, mostly on the weakness of the US dollar, currently 133.18. Resistance there. Maybe we'll put it a bit higher here. 133.60. Key lines are 134.80 to the top side and of course 130 to the downside, with 130.60 providing further support. Dollar yen currently around 101, the 100 level, of course, very, very important. We already dropped to 99 post-Brexit. Resistance at 101.50 and 103.40. Canadian dollar, dollar CAD, 131.40, just around resistance, 132.50 and 130 are lines to watch. Australian dollar, just under 76, 75 and 76.60 are lines to watch. Okay, the Kiwi, last but not least, quite a few movements here. 72.60 resistance, 71.60 support. Followed by 70.50. Yeah. Okay. I think we covered quite quickly the main things we talked about. So this is a very busy week. Bank of England is a huge decision. Watch out for the big NFP hints. So today the focus is on the pound and on the US dollar, moving a bit away from the yen. And well, let's see if the break higher of the euro is sustained. Also watch out for political developments. As we get closer to the elections, less than 100 days to go, the world's #1 superpower, they'll have more impact, okay? So that's it for today. Thank you very much for coming, for the great questions. I wish everybody a safe and successful day and week in markets. Those of you not going on vacation in August, for those of you on vacation, enjoy. And we'll be here we'll be here for sure next week. And that's it. So thank you, everybody. Have a great day, and bye-bye.